Good evening, everyone. My name is Adam Stock, and I am a founding partner of the Next Level Planning Group. Thank you for joining us this evening. To our clients, thank you for your continued trust. Thank you for introducing us to new clients. Thank you for coming this evening. To our guests, thank you for coming as well. I hope you find your time this evening well spent. I would like to recognize our team members. This is our team, continues to grow. I'm very blessed to work with such a talented, down-to-earth, cohesive team. If you're a client of our firm, you've had opportunities to interact with one or more of our team members and allow them to serve you. So thank you for that. As many of you know, I have a lot of kids. And my wife and I, Melinda, are trying our best to help our kids express gratitude, particularly when they receive gifts. And last night, our son Sammy wrote a thank you note to one of his friends for a gift that he received on his birthday. He says, "Hi, John. Thank you for the Lego set. My brother broke it. But, you know, that's the way brothers are. Thanks for coming to my party. Have a nice summer, Sammy." So needless to say, we did not send this to Johnny. However, what was really delightful about Sammy's thank you note is just how honest and unvarnished and raw it was. And so that's what we're bringing you this evening is unvarnished, direct communication. We're going to talk about the first half of the financial markets, which have not been great. Josh will review several themes. We will shift to an inflation discussion led by Richard Scheel. And then Cassie and Sarah will talk about the influence of money scripts in our life. And then we will, time permitting, have Q&A. If you have questions as we go through this evening, please send them in the chat. We'll try to get to them by the end of our time this evening. If we do not have a chance to answer your question, then your planner will be following up with you one-on-one to make sure that you answer those questions and get all your questions answered. With that, I would like to invite Josh Markowitz to join us. Josh, let me stop my screen share here. All right. Josh, you can come on and join me. Josh and I have been working together for 18 years. That's hard to believe. Josh continues to make major contributions to our firm and was selected to be one of the featured speakers at an industry event in Washington, D.C. this fall. Josh lives in Chicago with his wife, Anna, and their 2 cats. And without further ado, Josh, take it away.
Warm introduction. So, as you saw on the agenda, we are here to talk about the bad news. Oh, did I say bad news? It's, depends on how you view things. And as you'll see, when we get to the end of this, there is at least one little silver lining. So, to give you the outline of our 2022 halftime market review, here it goes. We're going to go through 5 key themes from the financial markets from the first half of the year. We will then look at the numbers, as they say on NPR Marketplace. You will see the stock market index returns and the returns of several of the major bond markets, particularly here in the US. And we will conclude with some summarizing thoughts. So, without further ado, here are the 5 key themes that we are going to walk through. Number 1, what should come as no surprise to most people, both stocks and bonds were both down in the first 6 months of the year. Now, historically, that is an unusual thing, although not completely unprecedented. We'll go into that in a little more detail. Key theme number 2 has to do with the difference between what are called growth stocks, companies like Amazon, Apple, Google, and the higher growing, more rapidly growing sectors of the economy, versus what are called the value stocks, companies like Procter & Gamble and public utilities, energy companies. They may be about as big as they're ever going to be, but nonetheless, they're out there on the stock market. You can invest in their shares. And there have been periods historically when value stocks, even though they may not be growing as fast business-wise as some of the growth counterparts, have actually performed better. And as you'll see when we look at the data, the first 6 months of this year were a pretty stark illustration of that exact dynamic. Key theme number 3, whoa, surprise winner. Looking more globally, not just at the United States stock market, but at the entire world, the so-called emerging markets actually squeaked out a slightly better rate of return than their domestic or so-called developed international counterparts. We'll look at some data to support that. We'll then touch on cryptocurrencies, so the so-called Bitcoins and Ethereums of the world. They got a lot cheaper than they were 6 months ago, but they might still be in a bubble. So we'll look at some information about that. We'll have a little discussion. And then lastly, to end on a high note, the silver lining, that safe investments, which we'll look at a few examples of, now actually pay more than they did coming into the year. All right, so with that laid out, let's take a look. Whoops. Go back into the presentation mode. Thank you very much. All right, let's take a look at key theme number 1. Okay, so we're going to look at a chart here that shows stocks and bonds. The blue line represents the S&P 500 index, and the green line represents the so-called Barclays Aggregate Bond Index. And as you can see, we're looking at the price performance over the entire first 6 months of the year. So, not a whole lot to comment on here, other than the fact that, yes, they're both down. Yes, stocks were still down about twice as much as bonds. And also, for those who might be doubting the value of diversification and risk management, if you look at the variance over the 6-month period, you will see that even though they both trended down, the volatility of the green line is considerably less than the volatility of the blue line. So anyway, we can certainly get into more detail if we had more time, but here's just a taste. What did US stocks do? What did US bonds do in the first 6 months of the year? So now let's take a look under the hood, so to speak, within the US stock market. The purple line represents what are called the growth stocks that I mentioned a moment ago, the Apples, the Googles, the Amazons. And the gray line represents value stocks, the old economy companies like AT&T, Procter & Gamble, your local public utility. Boring. Well, okay, what time period are we looking at? 2017 through the beginning of this year. This is a 5-year period, 17, 18, 19, 20, and 2021. And wow, look at that performance. Holy cow, the growth stocks up almost 200%. That means $1,000 invested at the beginning of 17 was worth almost $3,000 by the end of 2020. Meanwhile, the gray line, the stodgy old value stocks, okay, up 56%. And hey, over a 5-year period, that works out to more than a 10% annual rate of return. But if your goal is to pick the winner, so to speak, as opposed to diversifying and maybe having about equal weightings of both, then you might have been disappointed if you were like value all the way. Then again, if you were a growth investor, maybe you were lording it over your buddies who are more interested in those stodgy old economy stocks. That is to say, dun, 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 until the first 6 months of this year. Wow. The growth index gave back almost a third of its value. So from $1,000 at the beginning of 17 to $3,000 by the end of 21, back down to 2,000. Wow. The $1,000 loss is about 30% off of 3,000. What are you looking at here? 30.5% loss. Wow, this is part of the reason why we think it makes sense to balance both of these disciplines, both of these segments of the US stock market in a diversified portfolio. And for all that we've heard, we saw a moment ago, the S&P 500 is down 20%. Well, within the S&P 500, there are growth stocks and there are value stocks. And as you can see, value stocks didn't get hit quite as badly. Nonetheless, if we add the last 5 years with the first 6 months of this year, we're still looking at a pretty significant performance gap between growth and value. Where things will go next, that's really not our business to predict. We merely respond to what the market does by rebalancing and maintaining our belief that it makes sense to own portions of everything in reasonable quantities. All right, let's look at the next key theme. How about the so-called emerging markets? Here we're looking at stocks that are issued by companies that are based in countries like China, India, Brazil, even, I dare say, coming into the year at least, Russia. Oh my God. Yes, the emerging markets index coming into the year included some companies that happen to be headquartered in Russia, whose shares for many years have been publicly traded on stock exchanges in New York, London, and some other cities. Be that as it may, even with the Russian portion of the emerging markets index being written down to practically zero, an investment in the emerging markets index would have been down only 17.5% through the first half of this year. And by comparison, we got the gray line, which is the so-called developed international, which was about the same as the S&P 500, which is the blue. And then the green is the so-called Russell 2000, which represents smaller and mid-sized companies here in the US, which, as you can see, as a whole performed the worst. Let's talk a little bit now about cryptocurrencies, the Bitcoins and the Ethereums. Boy, they were so popular the last couple of years. Everybody was like, man, how can I get me some Bitcoin into my portfolio? Well, if you had it this year, you'd be crying the blues. No pun intended, if the color happens to look blue to you like it does to me. Though I'm a bit colorblind. If it's purple, I would believe you. Be that as it may, if you owned a Bitcoin on January 1 and you still owned it on June 30th, it would have traded in for almost 60% less in US dollar equivalent. And how about Ethereum, the close cousin of Bitcoin? I guess it's the silver to the Bitcoin gold. That was down even more. So if you're a believer in cryptocurrencies and you thought they were priced a reasonable, they were at a reasonable price 6 months ago, then you better be backing up the truck right now. P.S. That is not a recommendation. We are not able to recommend cryptocurrencies one way or the other at our firm. They're merely too speculative. Be that as it may, if we step back a little bit further in time, let's say we go back to the beginning of 2019 and we ask ourselves, well, how much more does a Bitcoin cost today than it did, I don't know, 19, 20, 21, 3.5 years ago? Well, the answer is it still costs a great deal more. And it's still the same thing. So buyer beware. That's all we have to say. Maybe Bitcoin and Ethereum will be the next, dollars and euros and British pounds, and they have to be worth a lot more before that will happen. Then again, maybe they will also go the way of the Dutch tulip bulbs. We just don't know. And let's move on to our final key theme from the first half of the year, which is some of the more boring assets that are out there for savers and investors. What are we talking about here? Well, let's start with what are called online savings accounts. So these are real banks. They are backed by the same FDIC insurance as your local brick and mortar bank on the corner. But some of them compete with those brick and mortar banks by offering higher interest rates to depositors that adjust more quickly to prevailing interest rate environments. 6 months ago, even a half of a 1% interest rate on a savings account was almost unheard of. Well, here you see now, as of just last week, Citizens Bank was offering 1.25%, Capital One, which has that big weird looking building out in Schaumburg. They're paying 1.2. Discover up in Riverwoods, also 1.2. Hey, it's not a lot, but it's more than double what they were paying 6 months ago. And again, no risk, backed by the FDIC. Of course, our partner Richard will talk in a moment about inflation, which is still a very real risk. And it's worth paying attention to, even if your principal happens to be guaranteed. What other types of safe investments are there? How about certificates of deposit, also known as CDs? Here you see, again, as of last week, what were the relatively competitive rates being offered. Here you see this is just by way of example, we don't specifically recommend any particular bank, but hey, here's a company called the First National Bank of America. Again, backed by the FDIC. If you loaned them your money for 1 year, they would pay you 2.5%. For 2 years, 2.75. For 3 years, a whopping 3%. You could lock it in for 3 years. This is much better than what was available, again, just 6 months ago. And then lastly, there's a less well-known product that is very similar to a CD that happens to be offered primarily by insurance companies that is called a fixed annuity. Like a CD, it has a fixed maturity date, and there's a version of it that locks in a particular interest rate for the duration of that period. So what you see here is that, again, as of last week, a company called NAC, which offered a product called the Guarantee Plus 5, was offering 4.25% for 5 years. 4.4% if you are willing to tie up your money with them for all of 7 years. These are much higher rates than were available just not that long ago. So this is the silver lining from interest rates going up. Well, to conclude, let's take a look at the actual index returns for both stocks and bonds. So here you can see the total returns for calendar year 2021 for US stocks as represented by the S&P 500, developed international stocks, companies that are located in places like England, France, Germany, Japan, Australia. That's the MSCI EFA. EFA stands for Europe, Australia, and Far East, and the so-called emerging markets. So obviously, you saw a moment ago, emerging markets, they kind of squeaked out a narrow victory relative to the others the first half of this year. Last year, they got trounced. Well, if anything, this is a lesson that it's not a good idea, at least certainly from an investment strategy standpoint, to just ask, well, what did the best last year, and then put all your money on that. Doesn't often work, certainly not the first half of this year. Let's take a look at bonds. So here we're just looking at bond markets here in America. Obviously, there are also bond markets elsewhere in the world, but this is where the lion's share of our clients' bonds happen to be located right now. So the aggregate bond market is taxable bonds issued by corporations, the US government, mortgage-backed bonds, municipal bonds, or cities and states, and then corporate bonds, specifically those that are on the higher yielding end of the spectrum. Again, here you see the returns from 21. How about the first half of this year? The exact reverse order. Once again, if you take away one thing from this segment of our presentation, don't just look at the returns from last year and assume that that's what's going to repeat the next year. The markets just don't work that way. So in summary, here are the 5 key themes. Stocks and bonds were both down. Growth stocks and value stocks, they're closer to where they were 5.5 years ago, although growth stocks still had a pretty commanding lead, although it was shrinking. How about the surprise winner, emerging markets? Let's not just hit the sell button just because we hear about bad news in one part of that world. Cryptocurrencies, interesting to watch, but totally okay to be on the sidelines. And then lastly, silver lining of rising interest rates is if you have safe assets in your portfolio, you can earn more on them than you did before. So to just leave you with a parting thought for the second half of the year, we would say this: it's always good to hope for better. You know, nobody likes to see their portfolio assets go down. It's reasonable to hope that better days will be ahead. And in the long run, most likely, things will be better. That certainly is how the past has played out. But at the same time, It's important to make sure that your financial plan can withstand even worse than what we saw in the first 6 months. Not that we're predicting, we never have a prediction about what's going to happen over the next 6 months, but it's important to be prepared. If you're not sure, ask your financial planner, hey, how would my outlook on retirement be? How would it look if, let's say, the stock market went down by another 20%? That's a realistic question. That's a financial planning question. It's a possible outcome. You should be prepared for it if it's going to play out. And also, always look out for those silver linings, even when they are few and modest like they are today. So with that, I will hand the presentation back over to Adam. Thank you very much.
Thank you, Josh. That was great. You covered a tremendous amount of ground in a relatively short period of time. So thank you as always. And now I would like to introduce Richard Scheel. Richard is the managing partner of our firm and leads our investment committee. Richard has his CFP and his CFA, which is shorthand for really smart. He is a graduate of Carleton College. He is an ultimate Frisbee enthusiast, and he lives in Appleton, Wisconsin with his wife, Jackie, and their 2 children, Nathaniel and Hetty. And as Josh alluded to, Richard will be talking to us this evening about inflation. Over to you, Richard.
Thank you, Adam. As Adam mentioned, inflation is what I'll be talking about today because it's been a very hot topic and for very good reason. The most recent, let me back up real quick before I dive into that. So what I want to cover tonight is, first of all, where are we with inflation? Second, where are we going with inflation? Third, how do different types of investments respond to inflationary environments? And then fourth, what are we going to do about it? How are we going to respond? So as we start with where we are, the most recent inflation reading that's been posted was 9.1%. That number may sound familiar. It's been in the news quite a bit. And that's a year-over-year inflation number. So it's comparing prices in June of 2022 to prices in June of 2021. They've gone up 9% over that time period. The last time prices went up that much, Michael Jordan was playing his first game of college basketball more than 40 years ago. So that's where we're at right now, coming out of the last 12 months. And so what I want to do first is break down that number into month-by-month segments. So this shows how we get to that 9.1% number on a month-by-month basis. And there are a few things that I want to highlight here. First of all, the last 6 months, the first half of 2022, inflation has been very high, even higher than the last 6 months of 2021. It's been over 5% just in the first 6 months of this year. Also worth noting, the highest inflation number came in last month in June. And all three of the highest numbers came in the last 4 months. So what this means is that inflation, those numbers are going to be in the year-over-year inflation readings for the next 6 to 12 months. So even if inflation were to slow down, that year-over-year inflation number that you see in the news is going to continue to remain high as long as these high monthly readings are in the data. So that's one thing worth noting as well. But before we just move on and leave it there, I want to dig a little bit deeper and see what has driven this inflation over the last 4 months, because it's been particularly high. And what's done that is largely food and energy. All other inflation items have declined, which we'll see on this slide. So the top blue line, that's the year-over-year inflation number from each month in the last 13 months. You can see on the far right, the last data point is just over 9%. That's where the 9.1% number is. The line below that is everything included in inflation except for food and energy. So why is it important that food and energy drove rising interest rates over the last few months? It's because they're generally the most volatile components of inflation. So you can see that inflation peaked for all of the other items in March, and it's actually been trending downwards over the last few months. but food and energy inflation has exploded so much that it's caused overall inflation to increase despite the decrease in everything else. So to summarize where we are, inflation in the first half of this year has been really strong. Overall inflation has been high, but particularly high because of food and energy, which are extremely volatile. And then even if food and energy and everything else stopped rising, we're still going to see really high inflation numbers in the news for at least the next 6 to 12 months. So the next question naturally is, well, where do we go from here? Where do we go from 9.1%? Can we go any higher? Will it get better? So we can actually get a really good read on what market participants, investors, expect for inflation by looking at the difference between treasury bonds that pay a fixed rate of interest and treasury bonds tied to inflation called TIPS. So it's a very simple example. If a one-year treasury bond paying a fixed rate of interest is paying interest of 3%, and a one-year TIPS bond has an interest of 0%, but its value will increase with inflation, we would expect inflation to be 3%, because then the TIPS bond will increase by 3%, the fixed rate bond will pay 3% interest, and you end up with the same result. If inflation were going to be higher, people would likely buy the TIPS bond. If inflation were going to be lower, they would rather buy the fixed rate bond. And because of that, if the expectations differ from that gap, people will buy one side or the other and drive the prices back together so that they end up being very similar. So if we look at these differences in yields, we can get a pretty good expectation of what the market is thinking is going to happen. So just to reset around where we're at, over the last 12 months, inflation has been 9.1%. Over the next 6 months, the market is expecting that inflation will decline, but prices will still continue to go up by 4.4%. Now, this is an annualized number. So actually what they're expecting over the second half of the year is about 2.2% from where we are at the end of June. And from there, the market is expecting inflation to continue trending downwards over the next 5 years or so. Now, you might be thinking, whoa, prices were up more than 2.2% over the last 2 months. Like, can they really be that low over the next 6 months? And there are 3 reasons why that seems to be a reasonable outcome. First, historically, the markets have been pretty good at predicting inflation. A few years ago, the Bureau of Labor Statistics did a study to see how accurate were these inflation break-even numbers over the subsequent time period. And what they found was that over the 5-year time frame, they're pretty much spot on. There was very little variation between what actually happened and what the market expected. Over shorter time horizons, investors tended to overestimate inflation. And there's some logical reasons for that. I won't get into them for the interest of time, but if we have time for Q&A, I'd love to talk about those as well. Otherwise, your planner can. We've talked about it quite a bit internally also. The second reason that this 4.4% number might be a pretty good expectation is because of the differences between high prices and high inflation. So inflation is the change in prices, not the price levels themselves. And what that means is that even if inflation slows down, prices are still rising. We don't feel it the same way because the prices are still high, but that doesn't mean inflation is high necessarily. So for example, at the end of June, the national average for a gallon of gas was $5. If at the end of June 2023, it's still $5, that means inflation for gas at least was 0. But that's still going to feel like a really high price because we were below 3 not that long ago. So what this is saying is, yeah, we actually are still going to have inflation. It's just not going to be quite as high. And if we look at historical inflation data, we haven't seen 4.4% inflation in a given year since about 1980 until the most recent bout of inflation. So the market is still expecting really high inflation, just not quite as crazy high as we've seen. And the third reason is that, as we saw earlier, the primary drivers of inflation right now are very volatile ones like food and energy. I mentioned gas earlier, being at $5 a gallon on June 30th. That's up over 50%, or almost 50% from where it was at the beginning of 2022. That's been a major driver of inflation this year. But in the first 3 weeks of July up to today, it's down almost 10%. So again, that volatility works both ways. As gas prices increase dramatically, that can push up inflation. If it falls dramatically, that can really help bring inflation down to a much more manageable level relative to what we've seen. So that's where we're at. That's where the market is expecting us to go. So how do different investments respond to inflation, and how can we use that? So with this backdrop, inflation is still expected to be high for the next 6 months and continue to slow down a little bit over the next 5 years or so. So a few years ago, Vanguard did a study on how well TIPS, those inflation protected Treasury securities, protect against inflation. And this chart shows the correlation between different assets and short-term inflation over a 1-year time horizon. So just as a quick refresher, a correlation of 1 means the assets move in perfect lockstep with short-term inflation. So if short-term inflation is high and the correlation is 1 with some asset, that asset is going to have a high return. If inflation is low, the asset will have a low return. If the correlation is 0, that essentially means they're not correlated at all. They don't have any sort of relationship. So if inflation is high, the return of that asset could be high, low, or sideways. If inflation is low, the return could be high, low, or sideways. So when we look at this chart, we can see that the best asset was 0 to 5 year TIPS bonds, very short-term bonds that had inflation protection. And then gold, commodities, more intermediate term TIPS, and then real estate had a 1-year correlation with inflation of effectively 0. And US stocks were just slightly negative, meaning they tended to move in the opposite direction, but it is not a very strong relationship. So one key observation from this is that the best asset, the highest correlation, is 0.48. So that's good, but it's not great. It's not super effective protection against inflation over a short time horizon. So I mean, it's not nothing. So we could look at this and say, great, let's just buy 0 to 5 year TIPS, gold and commodities, and call it a day. So why don't we just do that? So this is a very similar chart. It's from another study by Vanguard, also looking at inflation. It's essentially the same, but with a couple more data points and turned on its side. So they added cash and they added bonds. And so before we run out and buy TIPS and gold, what we need to understand is the difference between unexpected and expected inflation. So this chart looks an awful lot like the last one. And this chart is showing the relationship between those assets and unexpected inflation. So inflation that the market didn't expect in the break evens that we looked at earlier, when they do miss the mark. This indicates what happens to those assets when they do miss the mark. And the chart on the right shows correlations to expected inflation. So if inflation ends up playing out the way the market currently expects, what's the relationship for future assets? And a big takeaway is that a lot of assets are effectively 0, or even something like TIPS is actually slightly negative. Cash is very positive. Gold is a little bit positive. As Josh talked about cash earlier, it's great that it has a positive correlation, but a high return for cash is still leaving you short relative to inflation right now in terms of overall returns. So one thing that this highlights is, why does expected inflation have such a low correlation with almost every asset? And the reason for that is because when expectations for inflation change, that gets baked into asset prices really quickly. So a really good way to see this is to look at how assets have performed in the first half of this year relative to inflation and inflation expectations. So inflation expectations this year peaked around the middle of the year so far, the end of the first quarter. So right now, inflation expectations for the next 5 years are about 2.6%. At the end of March, they were almost 3.6%, and they've been steadily trending downward since then. So in the first quarter, we saw those expectations rise, and in the second quarter, those expectations fell. But throughout the whole first half, inflation was high. So this gives us a really nice case study with 2 different regimes and to look at how those assets performed. And in the first quarter, we get results that you might expect based on unexpected inflation correlations. The commodity index did really well. Gold did really well. TIPS, it still lost a little bit of money because of rising interest rates, but it did better than almost everything else. And bonds, which generally hold their value really well, had one of their worst quarters ever and underperformed TIPS as well. But in the second quarter, so we still had high inflation. But what changed is inflation expectations started to fall. And we can see that the return pattern looks very different. All of these assets were negative, even commodities and gold. TIPS was down even more than bonds that don't have inflation protection. And given how high inflation was, on the surface, that doesn't make a lot of sense. But the reason for it is that the TIPS returns have a stronger correlation with inflation expectations than inflation itself. So as inflation expectations come down, the value of the TIPS decline as well. So what this tells us is that even if we look at 1 year correlations between inflation and different assets, that might not be good enough. Because if this performance that's correlated with inflation is only based on unexpected inflation and it comes in these very short spurts, we have to be very aware of what inflation expectations are and what's actually going to happen relative to those expectations, not just the expectations themselves. So given all of that, given where we are, where we're going, expected versus unexpected inflation and how different assets perform, what do we do about it? So at TNLPG, there are 3 key ideas and principles that we adhere to when it comes to thinking about inflation relative to our portfolios. The first is always have inflation protection. As we saw, unexpected inflation is the inflation that really can do some damage to your portfolio, that can cause variance in assets. And by definition, it's unexpected. So you don't know when it will strike. It's kind of like fire. You can't get fire insurance to protect against a fire after the fire happens. You have to own it beforehand. So what we do is we keep anywhere between 10 and 25% of all of our portfolios in assets that tend to do well relative to unexpected inflation in the short term, like TIPS and commodities, as well as assets that tend to do well against unexpected inflation in the more medium term, which real estate and high yield don't necessarily do that well immediately, but they catch up in a much quicker time frame than something like stocks might. And then stocks tend to do really well in the long term. So especially for the more stock heavy portfolios, we don't need as much short and medium term inflation protection. But if a portfolio doesn't have as much in stocks, that's where we'll have more in TIPS and real estate and high yield bonds. Another key principle is don't fight the last battle. So because assets respond differently to expected and unexpected inflation, it's really important not to try to fight high expected inflation with assets that really only do well against unexpected inflation. Investing is inherently a forward-looking endeavor, and we have to be cognizant of what expectations are already priced into different assets and what that means for constructing optimal portfolios going forward, not constructing optimal portfolios for the past 3 or 6 or 12 months. And then the last key principle is return to the plan. As Josh mentioned before, keep coming back to the plan. What does it mean for your plan? Right? The point of your portfolio is to help you meet your objectives. Right? What you hear in the news, they're just trying to get your attention. They're trying to get your eyeballs. They're trying to get your time, and they're not trying to help you meet your goals. So it's really important to keep coming back to your plan, stay anchored to your plan. And we know that in the future, both near and far, there will be painful markets, there will be drawdowns, there will be high inflation, there will be conflicts and recessions and policy changes and any number of things. And that's why it's important that we continue to build portfolios that are robust to a wide range of risk factors so that when we do get high inflation, or we do get an unexpected policy change, or we do get a recession, it's not going to knock your plan off track. And on that note, I'll turn things back to Adam so that he can introduce our next presenters who will address another more personal aspect of planning.
All right, thank you, Richard. Inflation is a gnarly topic, very complex, and I thought you did an outstanding job simplifying it for us to all be able to get some sense of what is really inflation, and what can we expect. There was a question, I'm not sure if folks saw it, but there was a question like, what's historical inflation? And for the last 100 years, inflation's averaged about 3.25%. So when we're talking about 7, 8, 9%, gives you some sense in comparison about where that's at versus historical norms. So thanks again, Richard. Our final two speakers are Cassie Odesino and Sarah Bordone. And Cassie is a CFP who has been with the Next Level Planning Group for 8.5 years now. She lives in Racine, Wisconsin for a couple more weeks, and then she will be moving to Florida with her husband Leke and their 3 children, Ariola, Demola, and their 4-month-old Demidun. Sarah Bordone is also a CFP, lives in Chicago. Sarah was a Division I athlete at The Ohio State University, where she ran cross country. She's a rising star at the Next Level Planning Group and is an accredited behavioral finance professional. So gives her great authority to speak on the subject of money scripts, which are the subconscious biases that lead us to make certain decisions about our money and finances. So with that, I will turn it over to Cassie and Sarah will lead us off. Welcome and thank you.
Thank you, Adam. Okay, give me just one moment. I'll share my screen. All right, so we are going to talk today about money scripts. So Adam gave a brief introduction, but what are they fundamentally? So they were first developed by financial psychologist Brad Klontz, and there are 4 different types. Basically, what they are is they're unconscious beliefs about money that often are rooted in childhood, but they affect your adult behaviors and perspectives. Everyone has them. So to start this conversation, first think about your past. What is your first memory about money? So you might have to think way back for this. And where did you first learn it? Was it from your mom, your dad, a sibling, school, bake fair, whatever, craft fair, something? Where was the first time that you recognized that money had value and that you might need it? Where were you? And then how did that first memory shape how you feel about money today? Understanding that these underlying patterns can transform the way you think about your finances. So this topic is really about mind over money. The first script we're going to dive into is called money avoidance. So one of the most misquoted verses in the Bible, it says that the love of money is the root of all evil. But people who fall into the money avoidance category probably agree with the more popular and incorrect version that says money is the root of all evil. Money avoiders typically suspect that wealthy people are greedy or corrupt, and that there is virtue in living with less money. They might also believe that they do not deserve money or even feel guilty about the money they have. Because of these negative associations, money avoiders self-sabotage their own financial success or give money away in an unconscious effort to stay at a lower socioeconomic level. Studies have shown that people who fall into this category can be associated with trying to not think about money, just ignoring their financial statements, overspending, enabling others financially, and they have difficulty managing a budget. Studies have also shown that people who are in occupations that help people, like mental health providers or even some doctors, tend to score higher in this area than other professions like business or financial advising. So if anything on the screen, if anything that I said resonated with you, there are a few things you can do to flip this script. So the first thing is to create a ritual around being financially informed. The best cure for anxiety around money is exposure. So pick a time and a place to review your financial situation. Maybe it's a weekly meeting with your spouse, or it's every quarter with your financial planner, but having a set time and place where you know this is what you're going to look at and think about is really important. The second tip is to do well by doing good. So generate a list of ideas about how having more money is good for you and good for the world. You can think about philanthropic pursuits, but actually write it down and think about it, and then share it with someone. You can also look for a money mentor. So there's a lot of examples of wealthy people who fit that negative stereotype, but there's even more of people who don't. There are plenty of wealthy people who are doing good things in the world, like trying to help the poor, cure disease, whatever it is. So you can find someone who's a celebrity or someone who's in your circle, but just someone who's using their wealth to make the world a better place. And then you can strive to leverage your positive impact in the world by acquiring the economic means to do so. And then I, create a money mantra, like tell yourself why it's okay for you to have money. Like a mantra could be, the more money I have, the more good I can do in the world. It can be as simple as that. And then write it down on a Post-it note and keep that somewhere where you're going to pay your bills or interact with your finances, but read it often and say it to yourself. Finally, you want to set a budget and then reward yourself. So set achievable budgeting goals and increase them or stretch your goals over time, but start small. So having a budget and saving is like lifting weights. You're not going to go straight to 50 pounds, but start somewhere. And don't deprive yourself, because if you deprive yourself, you're just going to go straight to overspending, but keep track of your goals and reward yourself when you reach them. All right, so kind of the opposite of money avoidance is money worship. So if you're a money worshiper, then you believe that the key to happiness and the solutions to your problem is to have more money. But yet at the same time, you believe you really can never have enough. And you find the pursuit of money is never quite satisfying. So someone who has the money worship category might have thoughts like money is power, money is freedom, or if you just buy X, you'll finally be happy. So you're buying things to achieve happiness. People in this category are also more likely to put work ahead of family. And they're also more likely to give loans to people, even if they can't afford to. So money is a stabling force in your life, and you're using it to fill a void or provide security. But again, you often don't just sit on the money. You might overspend because more stuff equals more happiness. And this is one of the most common scripts because as a society, we really put money on a pedestal. And so they're really common. And even when they end up being destructive, they're often supported or revered. And it can be really difficult to swim against the tide. But tempering that impulse to attach your happiness to your income or wealth, possessions, it's good. Your happiness should be related to relationships, people in your life, not just your pocketbooks. The first thing to do to flip this script is to escape buyer's remorse. So buying new things is really fun and exciting, but surely after you purchase it, that thrill goes away. I remember I was so excited to get a video iPhone. I was 14. And I was the happiest I thought I was ever going to be, but that lasted 5 minutes. And then Apple came out with something else. So if you find yourself regretting purchases right after you make them, a great practice is to just put some distance between that impulse and when you actually pull the trigger. So take a minute and write down why you actually want to buy this thing you're about to purchase. This is especially helpful if you like to shop on Amazon or Sephora.com like me. Like, this is really helpful. But what is your intention behind that item? Like, ask yourself if it's something that you need or that your family needs. Or is this like, I am so tired from working so hard and I really deserve a treat? How does the purchase you're about to make fit your values and your goals? And you might reflect on these questions and decide to purchase that item, and that's fine. But just ask yourself these questions first. Slow down your actions and take some thought first. So don't just do something, stand there. And then the next tip is to make time for yourself and the people you love. So if this is your script and you're thinking money is everything, then yeah, having lots of money is great, but what will you do with it if no one's around and there's no one to share it with? Just like buying things, achieving wealth will quickly lose its luster if it's not attached to your values and goals. So for most people, spending time and doing things we love with the people we love is really important and valuable. When you attach money to happiness, it's difficult to curb your impulse to work longer and harder because you're rewarded with more money when you do so. But keeping your priorities in mind will help you maintain a healthy balance. And then set specific times every week to spend time with the ones you love. So again, kind of the opposite of money avoidance, where if you're avoiding money, you really need to set time to look at your budget. Do the opposite and set time to just spend time with loved ones and remind yourself that that's the most important thing. It will help you recharge your relationships, and it's just so much more likely to bring you happiness than money alone. The next script is kind of in the middle of the last two. So this one is called Money Vigilance. It's actually the most healthy of any money scripts, but to a point. So if you're money vigilant, you're really alert and watchful and concerned about your financial health. You believe it's really important to save to the future. There's a connection between hard work and financial reward. If you are money vigilant, you're really unlikely to purchase anything with credit. And nothing you buy is ever going to feel as good as saving money. You're also likely to be kind of anxious about your financial future, which inspires people to save, which is great. But you're also likely to be really discreet about your financial status. But you also are more willing to share details about your financial life with a close partner. So those are both great traits, and money vigilance really does encourage savings and frugality. But it can also lead to a lot of excessive wariness or anxiety that prevents you from just enjoying life and enjoying the security that money provides. So the first thing to do, if this is your script, is to have fun. And if you're already good at setting a budget and being a good financial analyst for yourself, then set a fun money budget and pick a fun activity or vacation to do. So maybe you're going to Mexico or Greece or Italy. These are just some of the places that all of my friends are currently in right now without me. But maybe you want to buy a new toy. And even if this makes you anxious at first, creating this space in your budget to enjoy your hard work will pay dividends in feelings of gratitude and joy, and will give you a deeper connection with those you love most. And then also remember, you can't take it with you. Spend some money on something ridiculous, which golf, if this is your category, that probably sounds awful, but it's really difficult assignment. But what's the point of spending a lifetime in frugality or deprivation and saving if you never allow yourself to do anything with it? So money vigilant, you've mastered the art of saving, and it's probably taken decades of hard work. And it's really hard to start spending that money. So you have to practice spending money and shifting your financial goals. So maybe start with something small. We talked about taking a trip, but maybe go to a spa, get a massage, but practice spending money on something ridiculous to break the ice. Okay, and with that, I will turn it over to Cassie to share the last money script and go even deeper.
All right, thank you, Sarah. We are going to focus on, I'll share one script and then we'll talk a little bit about how we can get this to work for us and not against us. So the fourth money script is very similar to money worshipers. Somebody in the money worship category is using money as a way of self-medicating. Those in the money status category directly connect their own sense of self-worth to their net worth. They believe that having more stuff than someone else makes them better in some way. Many people in this category, if you identify with it, they might believe that, hey, if I just live a virtuous life, the universe is going to take care of me financially. They may have grown up in lower socioeconomic environments, or maybe they lived in a household that prioritized the financial aspects of social standing. But in its extreme, money status is associated with overspending, excessive gambling, being financially dependent on others, and hiding expenditures from a partner or spouse. Now, I get it. We live in a culture, like Sarah said, we associate financial status with social standing. So it's really normal to want that latest and greatest toy and want to be successful. These thoughts and feelings are quite normal, but they can lead to detrimental financial outcomes when they're left unchecked. So if you can relate to this money status category and that kind of keeping up with the Kardashians mentality, a couple of tips for you. Number one, slow down. Very similar to what Sarah said for money worshipers, make some space between you and your financial decisions. Before making that purchase, ask yourself some really specific questions. Why am I buying this? What is it doing for me emotionally? Can I afford this? How exactly am I going to pay for it? How am I going to feel about this a week from now? Like, again, very similar to that money worship category. And when you answer these questions, look for some flaws in your reasoning. Things like, buying this item is going to make me appear more impressive or cool. Try to observe the emotions that you might be feeling. So take a step back and put on an observer's hat instead of maybe feeling some of those emotions for a minute. Maybe your emotions are around excitement and you want to treat yourself, or disappointment and you want to cover that up or mask that with a purchase. Similar to disappointment might be stress or anxiety or shame, or maybe some like empty feeling, then some need for fulfillment. And then the next question is the most important question. Is there a better way to meet that emotional need and whatever that purchase might be? And the second tip for this, to overcome this script, is to strive to be emotionally, physically, and financially healthy. I think that's really the point, right? That's what we all want. But some people who endorse this money status belief are quite financially successful. Their drive to secure their social status and gain those access to the finer things in life, like that's worked for them. But sometimes that drive for monetary success is accompanied with workaholism, which can harm marriages, relationship with kids, and physical and psychological well-being. So just make sure to take time for what matters most. Because financial success without the mental health and without those thriving relationships, is it really worth it? Probably not. So if you identify with this category, maybe one of those mantras that Sarah talked about is, you are not your net worth. It's a part of you, but it does not need to define you. Okay, now we've talked about all four of the major money scripts. Why does it matter? Why are we even talking about these? And we've alluded to it as we're talking about each one. And it is that the reason why these are so important is that they actually do predict net worth and behavior, particularly money avoidance, money status, and money worship. These are all associated with lower levels of net worth, lower income, higher amounts of revolving credit, and they can predict disordered money behavior. So financial infidelity, compulsive buying, pathological gambling, and financial dependence is just a few of the things that they can predict. And you can change the story you tell yourself about money. All of that is true, but it's not the end. It's not the period. It's not the final moment. You can change the story you tell yourself about money. So use these money scripts as tailwinds and not headwinds that are stopping you from reaching your financial goals, but as tailwinds that can help you get to where you want to go. So how do we get these scripts to work for us? One, identify those underlying beliefs. Take some time to ask yourself the important questions. And many of you probably did some of this work when you started working with us. Might be a good time for a refresher. Questions like, what did your mom and dad teach you about money? Like Sarah started this off with, what was that earliest experience? What are the most joyful and painful questions, experiences that you can recall about money? And there is a quiz if you would like to really identify and get some results from here. There is a quiz that Brad Kluntz put together. So you can take a screenshot of this or we can send it to you afterwards. So first, identify your beliefs. Next, validate. It's important to validate how you feel about money in those stories because there is an element of truth in each and every one of the stories. And there may be even instances in your life where that has served you really well. But that, again, that doesn't have to be the end all be all. So validate your beliefs and then challenge and change them. This is a direct quote from Brad Kluntz, a healthy mindset around money is a flexible mindset. So be flexible about how you think about money and flip the script by using some of the tools that Sarah and I have talked about today. Acknowledge that that story you're telling yourself about money is not serving you and choose to tell yourself a different story. And a direct example of how this might play out and how you might be able to apply this into your life would be how these scripts show up in our lives in relationships with our significant others. So if you have a partner or a spouse, chances are there's been at least one reoccurring argument about money. So use these scripts as a way to better understand your partner or spouse and resolve the conflict. Well, how do we do that? Sometimes we just need the step-by-step process. And Brad talks about first tabling the conflict. This can be really hard in the moment, but really important. And if we really ask ourselves, like whatever we're fighting about, whatever we're arguing about, or whatever we're frustrated about that our partner might be doing, it's probably not what's actually frustrating us. It's probably not what we're actually arguing over. Many times, more often than not, whatever we're fighting about is much deeper and rooted in some of these money scripts. So table the conflict, step away, get some space, let your emotions settle, and then get curious and have the conversation that what we all should have had on date number 5 or date number 7, and ask questions to your spouse. Get curious. Don't meet them with judgment, but get curious about what money was like for them growing up. What were some of their childhood memories around money? What are some of their financial goals and fears? How did they feel about where they were at growing up? What are they most proud of financially? And for you, what do you appreciate about your partner's relationship with money? This, for me, was one of the biggest turning points in resolving some conflict that my husband and I had around money, was finding how to appreciate the difference, right? Not making something different wrong, but making something different good. And what does he bring to his relationship with money that can benefit our family? And when I was able to recognize that for what my husband brought, it solved so many conflicts and so many arguments for us. So these questions might just give you a glimpse into the lens that your partner's looking through when they're making decisions that you just don't understand. And recognize also that our financial decisions are often rooted in emotions, and shame is a big one of those emotions. When we feel shameful about something, it prompts us to hide. It keeps us stuck in our financial behaviors, and it really does us no good at all. And when we shame someone else, that even makes it worse. So take a step back, get curious, ask questions to understand, and then flip the script. We have the power to change how we feel about money. If it isn't serving me, I can let it go. And one more thing that I want to cover before I turn this back over to Adam. I want to share about a program that we started a few years ago that's continuing to grow as part of our offering at the Next Level Planning Group. It's the Financial Wellness Coaching Program. This is a coaching program that gives employers an opportunity to provide financial coaching as an employee benefit. And we really touch on, when we are doing coaching with these employees, we're talking about a lot of these money scripts and how they show up, and trying to help people really flip these scripts. And we found this program to be a great way to widen our reach and impact by providing financial coaching to people regardless of their socioeconomic status or background. And like I said, this is a growing program. So if you're, seeing some of these things on the screen, or hearing this idea, maybe it sparks an idea of a company, business owner, or an HR person that that you think might benefit from something like this. So please don't be shy, and just let your advisor know, or feel free to reach out to me directly. And with that, thank you for your time. I'm going to hand things back over to Adam to wrap us up.
All right, Cassie and Sarah, phenomenal job. That was very, very interesting, and I really appreciate your preparation and delivery of the money scripts. It's definitely something for us to do some introspection and reflection on. Richard and Josh, you can come back and join us, and wanted to say thank you to you for your contribution this evening. All of you four did just an amazing job. We are a little bit over time, so we appreciate all of you hanging in there and spending part of your evening with us, and we hope that you enjoy the rest of your summer. You will be receiving a follow-up email with the recording of this. So if you have friends, family members who you think could benefit from the information, please feel free to send it along to them. If you do have any questions that we weren't able to answer this evening, please email your planner, and we will make sure to follow up with you promptly. Thanks again. Have a great evening.